Welcome to Part 1 of Auditing Standard number 5. This is Part 1 because Auditing Standard number 5 has over 100 pages, and for the layperson, that's a very daunting task to listen to or to read and understand. So what I've done is broken it into smaller, easy to understand components, such as in this section we cover the introduction, integrating the audit, and planning the audit. This training gives context to SOX 404 requirements. It's meant to be an easy to understand breakdown of dense words, and because the literature, there's so many parts to the literature, I have broken it down to smaller parts, Part 1, Part 2, and you can see here, based on your focus or the areas you're interested in, you can then listen to selected parts. And it's meant for people who need a refresher, or if it's your first time exposure to SOX 404, you can then get an overview. This table of contents came directly out of Auditing Standard 5 from the PCAOB. I've just made it into chunks so that it's easier to understand and follow. Let's dive into the introduction. What I'm going to do is I've given you the actual source of where you can get Auditing Standard number 5, which is found on the PCAOB website. What I'm going to do is slowly scroll through each of the paragraphs so that you can read it, but I'm going to talk about the significance of the introduction and some history, and some of this stuff I'll tell you. The first introduction, don't read all of the paragraphs. It's actually not that, it's a lot of words, but it's more interesting to hear the story. So many of you know that Sarbanes-Oxley Act of 2002 was law that was passed by Congress in 2002. And many people don't realize that Sarbanes-Oxley Act actually had many sections to it. That's why you have Section 302, which is on CEOs and CFOs certifying that internal controls are in place, they have effective internal controls. That's why you have Section 404, Sarbanes-Oxley Section 404, and really, Section 404 is what Auditing Standard 5 is really for. Now, what you may not also realize is Congress, when Congress passes law, it writes broad strokes. It just says, you will go do a couple of these things, but it doesn't tell you how. And so what Congress did do is it said we will create a new entity called Public Company Accounting Oversight Board. And it gave the PCAOB authority to make specific rules related to Section 404 and some of the other areas, how to do auditing. And that's why you have something called auditing standards. So the first rules that were created for specific to SOX 404 or Section 404 was actually Auditing Standard number 2. And Auditing Standard number 2 was very prescriptive. When the PCAOB started out, it started out with, let me tell you everything you're supposed to do. You're going to follow this checklist, and the rules were so general in some areas and yet so detailed in others that all companies had to follow it. So the rules applied to the big IBMs with multinational divisions and subsidiaries, and it also applied to the little biotech company that all it did was no revenue, clinical trial, and was just spending money for research and nothing else. And so the companies really started to, the public companies, public outcry was, this is so expensive. They were saying, great, it's great to have internal controls, but the weight of this legislation is just so much, we can't handle it. And so then Congress went back and heard this and then put pressure on the PCAOB to now write what is AS5, Auditing Standard number 5. So you now have a bit of a history of what AS2 was, and oftentimes you'll hear AS2 was superseded, meaning it's no longer in use, that a later rule applies, and that's why AS5 is used. So that's the introduction of how it came about. Now this section, the integrating the audits, let me give you some background on that. So for those who started their career before 2002, you will notice that the audit opinion of the financial statements was just on the reasonableness of the numbers, the actual numbers of what's in cash, what's in AR, what's in your prepaids and your fixed assets and your P&L and your cash flow and your disclosure. It was just about the end result. While the audit firms would actually understand some of how you got to there, we were mostly focused on, are the numbers correct? Can we tie it back to third-party confirmations? Can we do something? When Enron happened, when the Enron scandal happened, there was a recognition, and Congress had this big committee that was to put together and said, what are the root causes and so forth. And one of the root causes was to say, not only are the numbers that the investors rely on important, but the process to get to the numbers is also important. And so it's important to have internal controls over the financial reporting process. And as a result, the external auditors were required now to separate their opinions, and their opinions in the past. If you look at financial statements before the year 2002, it's a standard 3-paragraph opinion. You get the introduction, you get kind of the middle part, and then you get the opinion that says it's an unqualified financial statements, meaning we have no qualifications or reservations about the numbers and the disclosure that we're putting in the financial statements. After the year 2004, actually, was when SOX 404 came out, the opinions that had to be used by the auditors got more, you could have two separate opinions or you can combine it, but the paragraphs got very long. And that's the integration. So that's where you hear the word integrating the audits. The audit of the process of how you pull together the financial statements, and also the audit of the numbers themselves. So that's what paragraphs 6 and 7 refer to. Now we get to paragraph 8 of the literature, and you notice the note down here where it talks about, in some circumstances, particularly audits of smaller and less complex companies, the auditors can choose to not assess all the risks and so forth. Remember what I talked about was AS2 was so prescriptive. It said you have to do all of these things. And now with AS5, there's the recognition that we don't necessarily need all of these rules to apply, because for the biotech company, for the startup company that just went public, maybe they don't have revenue, so you don't have to do any of the stuff around revenue. Or maybe they don't have all the complexities. Can we scale back? And that's where you will start to also hear in future references, they talk about being risk-based. AS2, the original auditing standard for SOX 404, was very prescriptive. It didn't account for you have low risk or you have high risk. And so this note in paragraph 8 basically gives us license to say, make sure it's risk-based, that if it, in some circumstances, if it doesn't apply, then it's okay. You can skip it. You can have that judgment and not have to do so much prescriptive work. So that's the background on AS5, the introduction and integration of the audits. Let's talk about planning the audits next. You will notice now that these are guidelines for the external auditors to plan the audit of the internal controls over financial reporting. And you'll also notice here I've highlighted or changed in color red just certain words that's not in the original PCAOB. I'm just highlighting them so that you can focus on them, so that we can see the words that are most relevant to us. And basically, paragraphs 9 and the next several paragraphs related to planning the audit talks about, here are the factors that external auditors, and in our case, because we are the SOX auditors, we should also have to think about. And that is matters, first of all, knowledge about the company's internal controls if there were other audits done, other types of engagements done. You want to consider that in planning the audits. You want to also consider the industry that the company operates in. So if you are in the biotech industry, it might be different than if you're in the software industry. Software industry, revenue recognition is very critical. In the biotech industry, the clinical trial accruals, that's very critical, and that's often where mistakes happen or oversight happens because it's often outsourced. So understanding what industry the company operates in helps you identify general areas of risk. The next part of planning the audits is the company's business itself and its capital structure, its operating characteristics. So again, you may be in the biotech industry, but if you are doing AIDS research, it may be different than if you were doing another type of research and you have a lot of cash sitting around versus you have to get funding month by month. You also want to then consider recent changes in the industry or the company's operations. For example, if you have a new CFO, if you have a new sales team that's been brought on, if you've had major changes, a new system that's been implemented in the company, or they've had expansions internationally, these things we need to consider it in planning our audit. You also want to consider materiality and risk, other factors in terms of material weakness. You also want to consider control deficiencies that were previously communicated. So if you know that last year this company had material weaknesses, well, how did we remediate that? How did those material weaknesses potentially carry forward this year? Maybe things have changed significantly and it's a lower risk compared to last year, but if things haven't changed because of the material weakness, when maybe the risk is even higher because there may be management type of environment or tone at the top that we have to consider. There's legal or regulatory matters. So imagine if this company is working in China or doing business in China or countries where they call it the BRIC countries, B-R-I-C, Brazil, Russia, India, and China. If this company has operations in those 4 countries that are considered high risk in terms of tone at the top, potential bribery, you may be subjected to FCPA, Foreign Corrupt Practices Act. That's something that the company also has to consider. And there's also public information that's available about the company. Sometimes it's just doing research and staying aware of what's happening in the company. And as a result, if you are doing an audit of a company, staying up to date on the press releases, staying up to date on what's happening gives you an idea of if you get press releases about a new sales team being built, new products being released, that helps you stay in touch with what potential risks the company could be facing. And then the complexity of the operations. If the company has operations internationally, has lots of subsidiaries, and the consolidation can be complex, you want to consider that. And then you'll also see this note where it talks about many smaller companies having less complex operations. Again, this was a result in the backlash from AS2 being so prescriptive, the previous auditing standards being so prescriptive, that now in AS5, PCAOB has said, hey, if it's less complex, it's okay. You have to consider that as well. You may have fewer controls. Just because IBM has 2,000 controls, if you're auditing a smaller company, maybe it's just 150 controls. So that's where this note comes from. That's it on planning the audits.